Imagine a couple, they're both around 63 years old, and retirement is just around the corner. Their house is paid off, and they've accumulated about $1 million in tax-deferred accounts like 401ks and IRAs. They've worked really hard for this. And like many people, they assume once they retire, their taxes are probably going to go down. But there's one decision ahead of them that they don't even know they're going to have to make. And it's going to determine whether they pay tens or even hundreds of thousands of dollars more in taxes over their retirement years. Now, we're going to come back to this later. But first, let's fast forward 10 years from this couple that were 63, they're now 73. And that $1 million has grown to roughly $2 million. Retirement has been everything they hoped it would be. Then required minimum distributions begin. They're required per IRS to withdraw roughly $80,000 every year from these retirement accounts, whether they need the income or not, whether they want the income or not. The retirement they expected to be low tax doesn't look so low tax anymore. Nothing went wrong. Their investments did exactly what they're supposed to do. The problem wasn't the growth. The problem was never having a plan for what that growth would eventually create. And here's the part that most people never hear. Retirement doesn't eliminate taxes. It gives you new opportunities for tax planning. During your working years, your employer largely determines your taxable income. Your taxes were based on how much you earned, right? But beginning at age 59 and a half, you have something incredibly valuable: control. You decide where much of your income is going to come from. You decide how much taxable income to recognize. You decide how much of the lower tax brackets to fill. That control lasts only until RMDs begin. After that, much of the decision is made for you. You have to pull that money out of those tax-deferred accounts, and it will fill up your brackets. That's the decision I mentioned at the beginning. I call this the golden window. The golden window begins at age 59 and a half and lasts all the way until those RMDs begin. And during that window, there's going to be 3 opportunities that become much harder once it closes. The first one, number 1, you can consider Roth conversions while your taxable income may still be relatively low. Instead of waiting until RMDs force income into your tax return, you can intentionally move money over the tax fence into tax-free accounts. Number 2, you can intentionally manage your tax brackets. Rather than allowing RMDs to push you into higher brackets, you choose when to recognize income while you're in the lower ones. Number 3, you can coordinate your Social Security decision with your tax strategy. We're doing this for a client right now. They've already retired. We've delayed Social Security to keep their taxable income low. We're doing Roth conversions to fill up the brackets and turning on Social Security later. It doesn't work for everyone, but when it works with the right situation and with your numbers, it's a powerful strategy. For many retirees, delaying Social Security while using this golden window creates opportunities that simply aren't available later. None of these decisions eliminate taxes completely. We're all going to pay our fair share. They simply help you decide when you want to pay them. Now let's fast forward again. One spouse passes away. The retirement accounts are still there. The RMDs are still there. But now the surviving spouse is filing at a single filing taxpayer, and those tax brackets are going to shrink in half. It's the same retirement accounts, the same RMDs, just smaller brackets. And that's how a retirement tax problem quietly becomes a survivor problem, or what we call the widow's tax. Sometimes paying a little more tax today can mean paying dramatically less over the next 20 or even 30 years. Now let's go back to the couple we started with. Nothing about their story was unusual. They assumed taxes would be down in retirement. Instead, they entered retirement with a growing tax problem they never saw coming. The question isn't whether the golden window between 59 and a half and RMDs exist. The question is whether you'll recognize it and take advantage of it before it closes. If you're approaching retirement, one of the most valuable things we can do during a retirement review is determine whether you're entering your golden window and what opportunities may still be available before it closes. Most retirement mistakes come from blind spots people never knew to look for. A retirement review is designed to help you find yours. The link is below. I'll see you next time.